We go to manufacturing accounts. In the previous, it said the manufacturing business will, okay. A manufacturing business, that's the second paragraph there. A manufacturing business will maintain double entry records similar to those of retail and wholesale businesses. At the end of the financial year, in addition to an income statement and possibly an appropriation account and statement of financial position, a manufacturing business will also prepare a manufacturing account. The purpose of preparing this account is to calculate how much it has cost the business to manufacture the goods produced in the financial year. So for manufacturing account, it's part of the annual financial statement, but it is used to calculate the cost of goods purchased. Are you with me, please?
Can you repeat it?
Yeah, I will.
Financial.
It's financial. Well, for a manufacturing account, it's part of the annual financial statement that we prepare as a business. But what is the essence of producing or of preparing the manufacturing account? We prepare a manufacturing account to calculate the cost of goods produced, not cost of goods sold. If it's about cost of goods sold, it's the trading account.
Cost of goods
produced. So these are firms or industry that produce goods. So at the end, they're going to have their trading account, but they have to prepare also manufacturing account for the goods that the raw material. It means that they deal with raw materials. So if you deal in raw materials, that means you need to convert these raw materials into goods.
So the total cost of producing that without profit, that's so if it has a profit, which is the revenue, that means that
your manufacturing account, you add it up with your trading account at the end of it all. But first, you have to prepare your manufacturing account, which contains the raw materials, which contains the finished goods, which contains the work in progress. All these things, every expenditure that are attached to that raw materials will be added together. That's what we call manufacturing account. I think that's clear. So what are the elements? Here said the elements of cost. We have direct material. When we talk about direct material, we're talking about the first thing the manufacturer needs. They said the first thing the manufacturer needs is a raw material to make the finished goods. So these raw materials take many forms depending on the type of business. A baker will need the flour. A furniture maker will need the wood. A car maker will need steel and so on. So direct materials are like I said earlier, for manufacturing account, it is an account that is prepared to get the details about our cost of goods produced. So we have elements of the cost of goods produced. So one of the elements is the direct materials. I'm talking about direct material. We're talking about those raw materials that are needed for the production or for the manufacturing of those goods or finished goods. So they made the example of a baker. A baker in the bakery will need the flour. A furniture maker will need wood. A car maker will need steel and so on. That's for direct material. Then we have direct labor. When we talk about direct labor, we're talking about workers that are the ones that are engaged in production of that raw materials, in the conversion of those raw materials into finished goods. So here they said the next essential cost of manufacturer is the cost of the wages of the people who are employed in the factory making the goods. Depending on the type of business, this may be baker, carpenters, machine operators, and so on. This cost is sometimes referred to as direct wages. So we call it direct labor or direct wages. These are the costs of those that are linked with the manufacturing of those goods. I think that is clear.
Yes.
So the term direct labor includes only those people who are actually involved in the production of the finished goods. It does not include the wages of supervisors, maintenance staff, factory cleaners, and so on. These people have an important role to play within the factory, but are regarded as indirect labor. So there's direct labor, which is linked to those who are involved in conversion of those raw materials into finished goods. Not the cleaners, not the staff, not the supervisors. They are indirect labor. Yeah, they are important they are important in manufacturing too, but they are not directly involved like those workers that are in the factory. That is the point here. So we have direct expenses. So these are expenses which are directly linked with the production of that raw materials. Do you get direct expenses here? Yes. These raw materials are purchased, right? So
Yes.
whatever expenses, whatever spendings you made in the course of bringing those raw materials, they are all direct expenses because they are linked to the raw materials into finished goods. So they said it may be that for every item produced, a manufacturer has to pay a fee known as royalty to the person who originally invented the product. A manufacturer may have to hire a special piece of equipment to complete the manufacturing process. Such as expenses are regarded as direct expenses. So you have to pay royalty. What is royalty? A fee that you have to pay to the initiator of that raw material, those that have the raw material. It's just like you making a music. So you get royalty for that because it's your music. So you produced it. Do you understand?
So you give additional money.
Yeah, they paid it to you because you are the one that invented it.
Mm-hmm.
That's what called
So you
royalty.
give a credit, like it's credit. I mean, they give you credit that
it's your income.
Yes.
Royalty is an income paid by the business, so it becomes an expenses for the business.
Yes.
Is it clear?
Yes.
Then we have factory overheads. Factory overheads, they are sometimes referred to as indirect factory expenses. They include all the costs involved in operating the factory, which cannot be directly linked with the products being manufactured. Expenses such as factory rent and rates, factory heat and light, factory machinery repairs, depreciation of factory machinery, indirect factory wages, and so on are all embedded as factory overheads. So factory overheads are the indirect wages too. I think it's clear, right? So go to preparation of manufacturing accounts. So the cost of manufacturing the goods produced is calculated in the manufacturing account. The first item in the manufacturing account is the direct material. The cost of raw materials used during the year is calculated in a similar way to that of which the retailer calculates the cost of goods sold. The cost of raw materials actually used during the year is calculated as you have the opening inventory of raw materials, you had purchases of raw materials, you had carriage of raw materials, then you less closing inventory of raw materials. Just the same as
closing and opening.
Just the same as your trading section.
Yes, trading section
Of your income statements. So what you get is your cost of raw material, cost of production.
Cost of direct labor.
So the cost of direct labor is then added to the direct material. Any direct expenses are then added. So the total of these three elements of cost is known as the prime cost. So what is our prime cost? Our prime cost is direct material, direct labor, plus direct expenses. We know what direct material is.
Yes.
The raw materials that are purchased to make the production. Direct labor are those workers that are involved in that production. And direct expenses are the expenses linked to that production.
Okay. Yeah.
So that gives us our prime cost. I think that is clear.
Yes.
So the cost of production is found by adding factory overhead to the prime cost. So prime cost plus factory overhead equals to cost of production. I think that is clear.
Yes.
We know what our factory overheads are. All the indirect expenses.
Indirect expenses.
So indirect expenses plus prime cost.
Give us cost of
production.
Yes.
I think that is clear.
Yes.
Okay. Now they said the following information was provided by Capo Manufacturing Company on 30th April 26. Raw materials inventory. We have opening inventory, we have closing inventory, we have purchases of raw materials, we have carriage of raw materials, we have direct wages and we have indirect wages. So indirect wages are factory overheads. Are you with me?
Direct is
factory overhead, indirect wages.
Direct is labor.
Direct wages is part of it's direct labor.
Yes, direct labor or direct material.
Yes, but all these from indirect is not factory, it's factory overhead.
Yes. Yeah.
So what do we prepare it? So we have our cost of raw material consumed, which we have to calculate by what? Your cost of raw material consumed are opening inventory of raw material, purchases of raw material, carriage of raw material, less closing of raw materials. That gives us our cost of raw material consumed.
Mm-hmm. The formula that we
looked. Yeah. So opening inventory plus purchases plus carriage inward minus closing inventory gives us our cost of raw material consumed. I think that is clear.
The prime cost. Yeah.
not the prime cost. Cost of raw material consumed.
Cost of, prime cost
So
of
now we have our direct wages. We have direct wages, which is 166,100. We have direct expenses. What are our direct expenses? We have our royalties and the prime cost. Royalties.
Yes.
The amount royalties, you know what royalties is, right? The amount you paid to the inventor of the raw materials.
It's a fee.
It's an expenses here.
Yeah.
So royalty, they said royalty is 10,000, right?
Mhm.
So royalty plus direct expenses plus cost of raw material consumed is our prime cost.
Royalty plus direct
Wages,
direct wages, and then the
cost of raw material consumed.
Yeah.
So all these together give us our prime cost. So that's our prime cost. Now prime cost less cost of what's it called? Factory overheads will give us our cost of production.
Factory overheads plus and
Less factory overheads. Prime cost minus factory overheads gives us our cost of production.
No.
Yes.
Plus.
Prime cost minus factory overheads gives us our cost of production.
Plus.
Minus.
Plus.
Prime cost minus factory overheads
gives us the cost of production. No,
yes.
Plus.
Minus. What are your factory overheads?
Factory overheads is like insurance fee.
Sorry. Yeah. Oh, yes, it's plus. Sorry. We are supposed to add it together. Yeah. Factory overheads plus prime cost give us our, you're right. Sorry. So we have our factory overheads, which are indirect wages, insurance, rent and rates, general expenses, depreciation, all together with our prime cost will give us our cost of production. Yes, you're right. So that's our cost of production. So I think that is clear. Now we go to the work in progress. So when we talk about work in progress, we're talking about goods that are about to be finished goods. They are still in the process to become a finished goods. They are still in the process to become a finished good. That's why we call them work in progress. Do you get it?
Yes.
All right. So let's see what they said there. They said goods which are partly completed at the end of the financial year are known as work in progress. The work in progress is excluded from the cost of production, as these goods cannot be sold until they are completed. We don't add them to part of our cost of production because they are not yet ready to be sold. Are you with me? So they have some value, however, as it has cost something to get them to their present condition. Some materials have been used and some direct wages have been incurred and so on. It is therefore necessary to place a value on the work in progress. So the partly made goods at the end of the financial year are known as closing work in progress. These goods will, of course, become the opening work in progress at the start of the following financial year.
So if it's closing, that means it's done.
They are partly completed, but they are not yet fully completed. So they are our closing work in progress. So when because we finished the accounting year. So for next year that we are starting our accounting year, the closing work in progress will be the opening work in progress for next year. Yes. So the manufacturing account is necessary to adjust the cost of production so that it represents only the cost of goods actually completed in the year. This adjustment is done in the same way as other type of inventory. The opening inventory is added and the closing inventory is deducted. Just the same way. So what do we do with, as soon as we have our prime cost, we had our factory overheads.
We add them together to get the cost of production.
Yes, and we less our closing inventory.
Less of the closing inventory. So we're going to add the
prime cost plus overheads plus work in progress, opening work in progress minus closing work in progress.
That was the cost of production.
Will give us the cost of production for the new accounting year. Is it clear, please? Yes. So now we have to calculate the unit cost of production. To calculate the unit cost of production, it is just the cost of production divided by the number of units produced. I think that is clear. Yes. Now that we are done with preparing the manufacturing account, because we already have our cost of production, we have to prepare this trading section. Are you with me?
Yes.
So, preparation of a trading section of an income statement of a manufacturing business. The gross profit of the manufacturing business is calculated in the trading section of the income statement. This is very similar to that prepared by a wholesaler or retail business. The main difference is that because the business actually makes the goods itself, the item for purchase is replaced by the production cost of goods completed. Sometimes, however, a manufacturing business may purchase some finished goods which it does not manufacture itself. This may occur when production does not meet demand, when it is cheaper to buy the goods rather than make them. When those particular items cannot be made by the business, purchases of finished goods are added to the production cost of goods completed in the income statement. So we have purchases of finished goods. This is when the manufacturing company does not produce the product it's about to sell. It purchased finished goods. So you have to add because it's part of your cost of production. It's part of your cost. So you add it to your cost of production in the income statement. So we go. Now we have this. It said the following information was provided by Capone Manufacturing Company on 30th April 26. On 30th April 26. Cost of production, that is from the manufacturing account,
Yes.
is 475,000. Revenue is 661,500. Then we have the finished goods and inventory, then we have purchases. So how do we prepare this? Your cost of production, you add it with your inventory, you less your inventory, then you add purchases. Then you less it from your revenue.
So wait, let me get
You don't get it?
so
We need to get our gross profit, right? So to get the gross profit, you prepare the income statement.
Yes.
You prepare the income statement as soon as you are done with manufacturing account. It is manufacturing account.
Yeah.
So manufacturing account is done. We have our cost of production. Good. From the cost of production, to get our gross profit, cost of production should be less from the revenue.
Yes.
Cost of production should be less from revenue. But you have to think about your cost of production. If you have cost of sales, you have to add cost of sales to the cost of production. Then you less it from revenue. Do you get what I'm saying?
Yes.
So still our cost of production would have some items like opening inventory of raw materials. So cost of production plus opening inventory of raw materials minus closing inventory of raw materials plus purchases of finished goods. So that will give you your cost of sales. So your cost of sales minus revenue will give you your gross profit.
Yes.
Is it clear?
Yes.
So now we prepare the profit and loss section of an income statement. So the first thing, when you are preparing a manufacturing account, you get your cost of production. As soon as you get your cost of production, it becomes cost of sales in the income statement. You less it from your revenue. It becomes your gross profit. Then your gross profit from your overheads. Now we're talking about office overheads.
Yes, which is expensive.
Wages and all these things.
So
you less it from it to get your net profit. So let's see. They said the profit for the year of the manufacturing business is calculated in the profit and loss section of the income statement. This is very similar to that prepared by a wholesaler or retail business. Expenses related to the manufacturing process have already been entered in the manufacturing account. So only administration expenses, selling and distribution expenses, and financial expenses will appear in the profit and loss section of the income statement. Now let's prepare it. So we have raw materials for 15,300, work in progress 8,640, finished goods. So they say we should prepare, yes. So we have raw material inventory, they are all inventories. So you had all together.
That's a statement of financial positions.
Yes, that's for statement of financial position. No. I explained this one already. Oh, you want okay.
20.8.
I think you understand
Income statement,
profit and loss section. In the profit and loss section, the only things you had to it that you're going to less from your gross profit are office expenses, stationery if there is. What else do we have? What else do we have to add? Distribution expenses, because you have to sell those carriage outward. It's part of your profit and loss. Yes. Not carriage inward.
Outward.
Carriage inward is part of your cost of raw materials. Carriage outward will be added. What else? Maybe you have insurance. You had it. So whatever expenses that we didn't have, when in the course of our manufacturing account, we add them together here, then we take them away from the gross profit. That's our net profit. That is clear.
Yes.
Now for statement of financial position, it is the same as how we prepare the statement of financial position of a retail or wholesale business. So, but it's different here. What makes them differ? We have raw material instead of inventory. We're going to have raw materials first. So raw materials are part of our assets, aren't they?
Yes.
Raw materials, those goods that they are partly finished, work in progress will be added, and finished goods. These are all our current assets. Is it clear?
Yes.
So we add them all together, and that's our current assets. I think it's clear.
Yes.
All right. So we go to the year-end adjustments. So this chapter has concentrated on the difference between the financial statements of a manufacturing business and those of a trading business. In order to emphasize these differences, none of the examples included year-end adjustments. So a manufacturer may well have to make year-end adjustments for such things as accrual, prepayment, provision for doubtful debts, and so on. So I think that will be in the next chapter. Yes, that will be in the next chapter. So let's answer the questions. The first question said, how is cost of production calculated? Cost of production is prime cost,
yes,
plus factory overheads.
Yes. Increase in work progress. No, it's a B, because that's increase in work progress.
Increase in work in progress. What is increase in work in progress?
So when work in progress gets more, like production in progress is more.
Increase in work in progress is opening work in progress minus closing work in progress.
So it's A.
So the answer is prime cost plus factory overheads plus increase in work in progress.
Yes, because they've done.
Yes, is it clear?
Yes.
So it's A. Question 2. They said what may be included in the prime cost?
Prime cost. Wait, yeah, prime cost.
Prime cost is part of our cost of, it's part of the manufacturing account.
Mhm.
So we're not going to have.
No, one is not one of them. So no.
Salary of factory manager.
No. That's oh wait.
Salary of factory supervisors of production workers, wages of machine maintenance workers, wages of production workers. 3 and 4 are part of it.
Yeah, part of the but so it's 2, 3, 4.
Why did you choose salary of supervisors of production workers? They told you supervisors, managers, they are part of them, but they are not the one working.
Oh yeah, I thought you have to choose only 3.
So it's 3 and 4.
Yes, 3 and 4.
I think it's clear. So they said manufacturer provided the following information. Maybe we could quickly do that. They said, how much is the cost of production? Prime cost plus factory overheads plus opening work in progress minus closing work in progress. What do you get, please?
So it's 132,000
plus 17,000
plus 17,000
plus 11,000 minus 13,000
11,000
minus 13,000
13
minus 13,000. Yes.
So it's
132,000
132
plus 17,000
plus 17
plus 11,000
plus 11
minus 13,000
minus
13.
147,000.
Yeah, see. So the last one takes time, so we stop here.
Yeah.